this is a point at which you may or may not have gotten in, but we're going to be in a position here using our predicted high that we had here on December the 2nd. This is kind of our base where we're starting, and there are probably some other points of interest, like for example right here where we had a little hype up. Would we have traded that? Maybe or maybe not, because we didn't necessarily have all the indicators pointing in the right direction. But when we got to December the 2nd, we had a predicted high of 74.65, and as I mentioned, I'm using 50 pips as kind of my little margin before I get into a trade, because I don't want to have the market do something and give me one of those little fake out moves or little jabs or so forth and get me in a position that I don't want to be in. So I'm going to be buying at 75.15. 75.15 comes in. I'll put this mark in here, but it probably won't be exactly at the right spot. But just to give you the idea, 75.15 is a point at which we would be long. And after you see that move that we had there at 75.15, a couple of the reasons that we're getting into it is that, first of all, we had a situation where the predicted moving average is starting to move up. The predicted differences are starting to move up and have made kind of a crossover. The blue, more active predicted difference line moves above the green line, which is a bullish signal. And so when we are looking at the indicators, that gives us a reason to say we want to be long at this point, and that's why we would get in there, and perhaps not at an earlier point where the indicators did not agree with the long position. Whatever the case, we're going to be long at 75.15. And we're going to put our stop right back at that predicted low at 74.65, because we only said we were going to risk $1,000 total. If we were at 74.65 per contract, that would be $500 times 2 contracts. $1,000 would limit our risk. So if the market drops down there, that's our get out point, our escape clause, where we're going to get out and come back and trade it another day. Now, in this case, we were pretty fortunate because we had a situation where pretty much a one-directional move to the upside. It was not, maybe a surprise to anybody, but a lot of analysts predicted because of economic circumstances and so forth. And this was the beginning stages of all the little discussions about what was going on in Euro, and Greece was starting to come to the forefront and so forth. So the U.S. dollar index made a nice one-directional move, and the predicted differences were up, and everything looked like it was bullish. Now the question is, looking at what we have here, and we're in the trade, remember, at 75.15, the question is, how will we take profits? Or, will we put our stop in place to, kind of catch it when the market drops back, or are we going to set a profit target? Again, we have our price right in here, about 75.15 is where we entered the trade, right in that vicinity. And now we have a situation that kind of is a subjective one, depending upon you and your account and your risk tolerance and your approach to trading and all that. What do you like? So if there's a profit target, we're going to say, just for sake of argument, I like the number 3, so we're going to say that we would like to get 3 full points. If we get 3 full points, that's $3,000 for the U.S. dollar index. If we can get 3 full points, then we're going to take that contract, that profit on that one contract out of the 2, and take the profit, put it in our pocket, and that gives us a nice little cushion on which we can then trade some of the other, another contract or add to it or do whatever. But now we have a little thing that we have gained, and if we put that stop, that limit order rather, that we're going to be a buyer or get out, rather be a seller at 78.15, $3,000 that we had. That's one approach. You may think that, well, you've heard, let your profits run, that kind of thing. So you may not want to do that, or you may be a long-term position trader and you don't want to be real active, and you've read the various items, the newsletters and so forth, and how strong the dollar is going to be, so you kind of want to sit in there with a position and not really be too active about it and just kind of ride it all the way up, or at least as far up as it's going to go. So the profit target is one approach. So the next approach that we can possibly consider is, okay, let's say that we have a little setback, which we do, as you can see here. Now we can use our predicted low as a potential point at which we're going to set a stop and to get out of a market. This particular case, on December the 23rd, we had a predicted low of 78.13. So we would be putting our stop, if we use that 50-point difference there, at 77.63. There's other places you can put that stop. You've made some money. You may not be quite so anxious to, to press it, but it's going to be somewhere in this vicinity right in here. And as you can see, eventually that stop is going to get hit. And, have you kept both contracts, and now that's the one contract you get out of, and you're going to ride the other? That's a decision that you will have to make. A couple of points about this particular time, December 23, you're going into a holiday period. It's the end of the year. You have all these various accounts being shaken out, taking, kind of evening up or for positioning themselves. So maybe it's best, you might think, if it is a profit. You have your profit. Okay, you didn't get maybe the maximum profit, but you're going to get stopped out on the one and protect the profit that you do have, and maybe you want to sit this one out. Maybe you want to just kind of ride along and see what happens with the dollar first, because you have to remember, when we're looking at the point at which we're looking at, we don't know this market is going to trend all the way up. That's an unknown. It's kind of like we're still on that hard right edge of the chart, and we don't know that the market is going to make that long trend. So, we trade a little differently when you know that than when you look at the chart and then you say, okay, in hindsight, here's what I do. But if you're looking ahead, it's a lot different. So you might have, even in a situation like this where you had the setback, you might have said, okay, this market has dropped down. Maybe that's all the dollar's going to offer me. And you might have even looked at a position here on the predicted low as a point at which you then would get short for a time. Maybe you get out of your position entirely and you would even go short as a trading market. That's another possibility. You don't want to let those profits get away for sure, and if the market's going to turn on you and go short, then you want to be able to take advantage of that too. So, that's another possibility. But in this case, we're going to kind of move ahead. We can't, focus on every detail, every possible trade here as to how it's going to handle, but we're going to move ahead until we get to the point in mid-January. We have a situation in mid-January where we have a contract that, the move starts to move back up. We have a candle, rather, that gets above the predicted high. We have the predicted differences starting to turn up again. The predicted moving average starts to turn up. So now we have a situation that is either a get back in type of situation or potentially an add-on situation if you have maintained that one contract, or even two contracts if you think the market's going up forever and you're going to hang in there and just ride the wave. So when you look at what is going on, where this is approximately an entry point at around 77.67 if I use my numbers correctly, looking at the predicted highs and so forth. So someplace right in here at 77.67 is where you potentially could be long again. Well, now you have some of the same issues that you just